welcome to the Wiser Weekly Roundup, where we cover 5 topics in 20 minutes. Hey, Brad.
Hi, Casey.
So let's get started. First topic, is it time to refi your mortgage?
Well, it's a great question. It's been a question that people have been asking themselves now for the past 6-7 months. We're seeing interest rates inch up a little bit, but relative to historic norms, they're still very, very low.
I mean, I think I saw a 15-year get down to 1.99% at some point with a person who came and did a refi, or we helped with a refi.
Yeah.
So that's crazy. I think there's several scenarios. I mean, if you have an adjustable rate mortgage right now, I think that it's time to make that a fix.
You may want to lock that in.
Yeah, there's no doubt about that. I think rates have some room to move. I would argue, at least in the Atlanta market, what we're seeing with these home prices, maybe an increase in rates would kind of cool things down a little bit. If you have a reasonable home, move-in condition, we're seeing multiple bids. It's a great time to be a real estate agent, I feel like.
I think they're probably as busy as they've ever been. I've talked to other people who have thought about putting their homes on the market or did put their homes on the market, and they're getting multiple offers in 24, 48 hours.
Well, I think as far as the people at home who have rates at 4% or higher, you probably should at least be getting some quotes right now, whether or not to refi. Generally, that 1% difference, 1% lower rate is better. It's better to go ahead and refi that mortgage. But I would encourage everyone to try to get a 15-year. I wouldn't take out a 30-year at this point. Still a lot of interest, you think, over 30 years. If you can get a 15-year, maybe 20 is the backup. Try to get that house paid off before 65 would be the objective.
That's a great idea. The idea is then to work with a professional to determine what's going to work in the best interest of yourself and your situation. So don't be afraid to reach out and talk to somebody about your financial plan and whether or not a refinance makes sense for you.
Yeah, absolutely. Even at 15-year, you might still be worth buying down some points to get that lower rate. But there's the big thing is just looking at the break even. Just Google mortgage interest amortization schedule or mortgage rate calculator, and what you need to do is go in and look at the interest that you'd be paying now. Dave Ramsey on his website has a great mortgage calculator. Put in your current rate, your current amount owed, along with your amount that you're paying each month on principal and interest, and it'll tell you, this is how much interest I'm paying over the remaining life of my loan. Then go put in a new mortgage into the same calculator and look at that interest difference. And when you do that, you can see if it's worth refining or not. But make sure you put in the new mortgage rate, because a lot of times your closing cost, you probably shouldn't put escrow payments into your mortgage, but people do it.
Yeah, you want to keep it an apples to apples comparison.
Correct. So, but put the total new amount that's being borrowed in the new calculation, and then compare those two, and that will tell you very quickly whether or not refi makes sense.
Yeah.
I haven't seen too many people with 5 or 6% mortgages, but I know they're out there statistically. Time to wake up.
Yes.
And get those lower rates. One trend that I've noticed, I think we'll cover this a little bit later in our topics, but one trend I've noticed is people are actually cashing out of is kind of remnants of maybe pre-financial crisis.
That's right.
Pulling cash out of their homes. That concerns me a little bit.
Cash outs last year were somewhere in the neighborhood of $152 billion of cash out, which is the difference between the amount of the previous mortgage and the new mortgage loan that was taken out.
Yeah. I mean, if you're adding on to the home, you're doing something to increase the value of the real estate. That makes sense. If you're paying off credit cards with it, that's great. You got credit cards paid off. Now you're going to pay for your credit cards over 15 to 30 years. Right, at a lower interest rate. Which is not tax deductible. Everyone thinks mortgages are tax deductible these days. Very few people get to actually deduct their mortgage on their tax return. But cut those cards up. Make sure you don't get back into the mess again.
Right. That's the key. It's a behavioral issue.
Because then if you have the debt again, then what are you going to refi at that point? You get stuck. But But yeah, okay. So go refi. 30 years should be around 3%. 15 year I'd be around 2.5, 2.25. So those are really, really low rates. Even if rates increase to another percent, historically, that's really
They're still
low.
low.
Absolutely.
They're still low. Yes.
Next topic, the 60 portfolio. The 60-40 portfolio. This is a traditional moderate risk portfolio that investors use. And I think it's quite humorous that every time we get in these low rate environments, that all of a sudden all the topics are the 60 portfolio is dead. Moderate risk, 60 stock, 40 bonds won't work anymore. You have to do something different. We heard this all coming out of the financial crisis. The data shows they're wrong. But I think what we have to be careful of is who's telling us that, right?
Yeah, I think that's true because there are new products and services in the financial industry that are being brought out on a daily basis almost. And they're all trying to find their place in the traditional portfolio. And in order to do that, they may have to try and break that portfolio and then recreate it with their product and service in it. The traditional 60-40 came out of the old pension world, basically. This is an institutional benchmark. 60% stocks, 40% bonds. When interest rates were much higher, it was growth from the stocks, income from the bonds, creating a moderately risky portfolio. We looked at this, Casey. We looked at the period between January of 2009, which was just at the end of the great financial crisis, but we're still in it. Mm-hmm. Interest rates were lowered to between 0 and 0.25 for the Fed funds. They remained in that range bound until December of 2015, 7 years later. So if you isolate that period in time and you say, okay, this is about as low as interest rates are going to go, how did a 60-40 portfolio do?
How did it do?
It did great. On a total return basis, it was up 116%. So it more than doubled in that time period on a moderate risk portfolio, receiving little to no income from the fixed income side. All right. So when people are
and that's the problem,
prognosticating
right,
the 60-40 portfolio being dead, they're looking purely on a forward-looking basis, on an expectation basis. They also need to look backwards and say, okay, how does the 60-40 portfolio return look like during a downturn or a drawdown in the market? Well, we have a great example. We have March of 2020. The 60-40 portfolio went down 2/3 that of a full 100% stock portfolio. So it outperformed a 100% equity portfolio by 33%.
And this portfolio we're talking about is not necessarily our portfolio. It's just what 60-40 is.
That's right.
It's the index funds. Nothing hokey pokey about it. Just your traditional index funds and an aggregate for the 40%.
That's right. Right. Just looking at if the investor did nothing other than bought the total market for stocks and the total market for bonds in the U.S., what would their return be?
You know, what the risk is that on the 40% of the portfolio, which is in bonds, people are saying, well, there's going to be a low yield environment. It's probably a zero rate of return going forward. That's what they were saying after the financial crisis too. But what their solution is to move into high yield bonds, emerging market bonds. They'll add private equity to the portfolio. They'll do things to the portfolio that are actually increasing the risk of the investment. And that's not, small emerging market bonds, sometimes high yield bonds have just as much risk as small cap stock, right? Just as much deviation. So we have to be careful that we're taking on more risk. There's no free lunch. We're going to take on more risk to try to solve the bond side, where really the bond side is there to protect us from the big sudden market fallouts, right? So if you don't like the 60-40, if you don't like the bonds, I think the simple solution is you add a little more equity, knowing that you're taking on volatility, as opposed to adding things to the portfolio that you don't really know anything about.
That's right. And a lot of these new products and services don't have a long track record. And so they don't know how they're going to perform necessarily in a volatile stock market. I mean, there are such ideas that looking at BDCs that have a very high yield, but they have a very, very high volatile factor as well. price swings during interest rate movements. Now, it's expected that interest rates are going to remain low for some time. They may creep up a bit, but there's very little pressure on upwards, for the long term on yields. So we may be in this, market for a while. We have a very good example, the one I just quoted, right after the great financial crisis, where fixed income yields were very low for 7 years. So history, may not always repeat itself, but it's a pretty good indicator.
Yeah, that's right. Well, history doesn't always repeat itself, but does rhyme, right?
That's yeah.
All right, next topic. Kind of the same, or a good segue anyway. Economic stimulus.
Wow, have we stimulated the economy to the tune of $5 trillion in the last 12 months. Now, granted, not all that's in the market, in the economy yet. There's still, this most recent one at 1.9 trillion signed into law here this past week or so by President Joe Biden. And it's going to take a while for this to find its way into the market. But nonetheless, stimulus checks from that package are going to be going out. Unemployment increased benefits will be starting here in a week or so. We're looking at an increased money supply in this country that we haven't seen since right after World War II. And there's just no way that the economy is going to be unaffected by this. A lot of this money is likely to find its way towards the market, either directly or indirectly. Directly, there may be investments made in the markets. Indirectly, people are going to spend their stimulus checks. People are going to spend those increased unemployment benefits. People are going to spend their tax credits for new child tax credit, etc. And they're going to spend it at businesses that use that money to pay employees who they in turn spend and buy things. And
what's interesting is we have rising incomes in the country. We have record refi cash outs, which we just talked about.
Right.
We have record household net worth.
Household net worth is up 13% in the past year. That's amazing.
And then now we have these additional stimulus checks that are coming in, which I believe you saw an article recently. It was at 40% of that more than likely will end up in the market.
Yeah, surveys are being taken all the time. And I think Deutsche Bank, I saw, did a survey, and they asked people, what do you think you'll use your stimulus check for? And somewhere in the neighborhood of 40%, a little bit more, a little bit less based upon age and demographics, said they were going to put it in the market. They were going to invest it. Now, that means that 60% is going to be spent, but 40% of trillions of dollars or hundreds of billions, nothing else.
I mean, I have so many thoughts with that. I mean, one is if 40% is going to be put into the stock market directly from the person who received it, maybe we got the stimulus wrong. Maybe the person receiving it doesn't really need it, or it's being stimulated incorrectly. You think, these stimulus checks, these are going to people who can't pay their mortgages or can't pay their rent or can't put food on the table. And I'm sure there's some of that, but there's also some of it that probably just an unnecessary expense. So maybe if it's going back into the market and that pushes the market higher, then that benefits the people who paid for the stimulus in the first place.
Maybe so. No. Household savings accounts are up $2.5 trillion in the past year. Highest they've been, if not forever, in a very, very, very long time. So up to $3.9 trillion of savings, household savings, not net worth, savings.
And that's a good thing.
That is a good thing.
Most people need to have more in savings.
That's right.
Yeah.
Either having it to make future purchases, future investments, or holding it as a reserve against future. My
concern, though, is that debt is rising again.
That's true.
Consumer debt is going up, which is not a good thing.
Right. And we've all heard about student loan debt being as high as it is. So debt levels are extremely high. Government debt levels are extremely high. So
I'm very much a Dave Ramsey fan in terms of how we handle budgets and being debt free and really payment free. Because in a low interest rate environment, you can get really cheap credit or really cheap interest rates, even zero for some purchases. But you're just playing with fire, I think, for most families.
It is. It's
middle America anyway.
It can be very seductive.
Yeah. Next thing you know, you've got, $4,000 and 0% interest payments.
Right. You still got to make those payments.
Yeah.
You know,
and not enough money going into your 401k plan. That's
as
a bad
you said,
recipe.
reduce your payments. It's like getting a tax-free raise from your from your income.
That's right.
Yeah,
that's right.
Just simply not having to make that payment.
All right, let's hop to the next topic. No more desk.
This is interesting.
No more desk. I came across a Wall Street Journal article recently talking about how the pandemic is going to change office space. Now, we see that in REITs. REITs have lagged a little bit in coming back from the market crash.
Right, the office side of REITs.
Correct.
Yeah. The industrial side and commercial side is doing well, which is a shift in how we utilize real estate resources.
True. But this article is focused only on the larger companies and how they think about office space. So what I found interesting is they're going to eliminate desk. No more desk. Very few desks. You could reserve a desk. Imagine not having your own desk. I need my desk. I have stuff in my desk, right? I mean, I have everything organized and start my work day at my desk and finish my work day at my desk. But the desks are going to go away. If you want a desk, you can reserve one for the day, but it's not yours.
Right. You have a locker.
you can have a.
It's like school.
Yeah, it is like school or the gym. Hopefully, your lockers are better than the gym's lockers. But the whole idea here is that we're gonna go to work and we'll have collaboration spaces, and then our team leaders will say, "Hey, go team," and we'll say, "Yeah, go team. We're gonna do this project," and then you'll leave and go home and do your work, and then you won't come back to the office again until it's another time for another team meeting. So there's no collaboration in person. There's no company culture really being developed because you're not near each other. So then they have to add company culture events. So you'll come back to this space for company culture events, right?
Right. Right.
So
the culture won't occur organically.
No, they have to kind of force culture
through activities and team building exercises.
Yeah, I have so many thoughts on this because I think about going through the pandemic and the people who don't have children are like, oh yeah, I love working from home. This is great. I'm in my pajamas. I'm just doing these Zoom calls. And the people who have kids are like, get them out of the house. Like, I need to get back to my desk. I need to get back to my quiet spot.
Yeah, this is a major shift in how we work and how we live. It should be interesting that what sorts of careers are going to be more adept to it than others. Now, obviously, if you're working in an environment where you're creating and building things, you're going to be at your workplace.
Right.
If you're working in an area where it's more intellectual, in terms of creating programming, creating systems and things, you may be much more adept at working remotely. But what does that mean about how we interact with individuals and people on a social level with where we work? How do we create that feeling of, I am loyal to my company or my company's loyal to me? If all we're doing is working on one project from one to the next, to the next, to the next, and we meet each time a project kicks off and each time a project finishes.
Yeah. Or just working from home and doing that efficiently. I wonder about that, but I don't know. And then I worry about the next generation, the new generation coming out of school now that want this work-life balance. Just means they don't want to come to work, but they want a paycheck. And I don't want to put everybody in that same box, but we've had some experience with that, and so it's changed, and we'll work through it. But we used to all have offices. Then we all gave those up for cubicles in the 60s, and then that kind of progressed into big workspaces. And then now those big workspaces are going away, and they're like, well, don't be here. Just don't be here unless you need to meet with someone else, and you can rent this desk for the day. But, it's going to be interesting. I don't think that derails REITs. I don't think that derails office spaces. It just means that more space will just be used differently.
Right. It'll be
reutilized. Companies are saying that there are going to have less than need less space. Some of those same companies have actually had layoffs. So I don't know how much less space there will be, but it sounds like contractors will be in business for quite a while as they tear down walls and bring in temporary desks.
I think that's very likely, both at a commercial level and at a residential level.
Yeah.
People will have to rework and reformulate their homes to
Yep.
accommodate work at home. So you have definition. And this is something we were talking about earlier, in preparing for this, is how do you create definition when you live at home, work at home, and everything else at home? There's no commute. There's no turning off your computer and leaving it at your desk. Your phone and your computer go with you everywhere you are. So although a person may, in the middle of the afternoon, be running an errand, they may be taking a conference call with somebody in a different time zone at 10 o'clock at night.
Yeah.
So the definition of work and live.
I see some risk here for sure. We're in the bonus time now of our 5 and 20. So let's hop over to the travel rebound. More people on airplanes now.
This is great. People are getting out and going places, going back to vacationing.
Yeah, you can't find a place at the beach right now. If you're looking for one, at least down on the South Carolina side.
If you're looking at Airbnb or VRBO, you can just see those prices going up every single month as these owners are recognizing.
40% of travelers now are saying that they're going to go international in 2021, probably late 2021.
That's great. That's great. And as they travel, they stay at hotels, they stay at resorts, they go out for dinners, they spend money.
It's definitely, you can see the economies are going to benefit. So Florida, if you're a resort in Florida, you're looking pretty good right now. Your governor opened up the state. Texas, your state's open. Other states that are shut down, I think they struggle through the rest of 2021 because people are going to go, I can go here and I don't have to worry about all these mandates. So that's going to be interesting to see the uneven rebound amongst the different travel companies.
Yeah.
Delta still has middle seats blocked. Other airlines are like, come on, everybody, get on.
And the thing about the travel and leisure industry is that the infrastructure is already there. The capacity already exists. It's not like revamping up a manufacturing facility and getting it going. That hotel, those rooms are already there. They're vacant. They're open. You can fill those by just picking up the phone and calling them and seeing if you can spend the night.
Absolutely. Well, I think that's great for our country, and it's great for the governors that have been pro-business and helping open up the economy again. So, all right, Brad, good discussion. See you next week.
Sounds great.